Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The strategic landscape for UWM Holdings Corporation, UWMC, it just fundamentally shifted. On December 17th, 2025, they announced a definitive agreement to acquire Two Harbors Investment Corp., that's TOW, in a massive $1.3 billion all-stock transaction. Now, this should be viewed really as a transformative move. It's specifically designed to resolve the company's core structural weakness. And yet, the immediate price action, the first data point we have, saw UWMC shares drop about 7.4% on some really heavy volume.
I mean, does that 7.4% decline actually reflect fundamental concerns? I'm talking about the immediate, unavoidable equity dilution. We're looking at an issuance of 108 million new shares and the very real operational integration risk. Or, as you're suggesting, is it all just a mechanical market artifact that's, obscuring what you believe is a truly value-accretive strategic shift?
My position is that the drop is a temporary technical distortion. It's driven by factors that are, frankly, extrinsic to the company's long-term financial health. When you look past the noise of a single trading day, this acquisition creates a resilient and all-weather financial profile. It fundamentally changes UWMC's trajectory from, a volatile, cyclical mortgage bank to a mature financial compounder with stabilized revenue streams.
See, I come at it from a completely different perspective. I believe the magnitude of that decline is entirely justified. The immediate supply shock from issuing over 100 million new shares, combined with predictable market mechanics like forced selling and hedging pressure, it creates an immediate headwind that, in my view, outweighs the perceived long-term benefits. And those benefits are heavily weighted toward difficult execution and uncertain timelines.
Okay, let's elaborate on the strategic value, because it feels like the market is focused entirely on short-term volume flows and not the structural fix. Look, the deal's primary goal is resolving UWMC's greatest structural vulnerability, that boom-bust cyclicality that's just inherent in origination income. By absorbing Two Harbors' substantial $176 billion mortgage servicing rights portfolio, the combined servicing book now reaches approximately $400 billion in unpaid principal balance. That is a game changer.
It's a massive scale increase, certainly, but let's pause on the mechanism there for a second.
Well, this scale creates what we call the robust natural hedge. Servicing income, which consistently rises and extends in value when higher interest rates suppress new loan production, acts as a critical ballast. So when rates are high, originations fall dramatically. But the MSR book generates stable, recurring cash flow that actually appreciates in value. And then conversely, when rates fall, MSR value plummets because of prepayments, but the high-margin origination machine surges back. This counter-cyclical revenue stream fundamentally stabilizes cash flow, making that attractive 7.4% dividend yield better supported and, frankly, more sustainable than ever before.
I grant that the theory of the natural hedge is compelling on paper. It's the holy grail for a mortgage bank. But we need to look at the immediate costs and why the market reacted with such pessimism. That 7.4% price drop isn't a mystery. It's largely driven by identifiable non-nefarious market mechanics. But these mechanics reveal genuine supply pressure.
Such as the merger arbitrage?
Precisely. First, you have textbook merger arbitrage. Arbitrage funds buy the target, Two Harbors, to capture the announced premium, and they simultaneously short the acquirer, UWMC, to hedge their market risk until the deal closes. That is immediate mechanical selling pressure right there. Second, and this is highly material, is the forced seller effect. Two Harbors is structured as a REIT, a real estate investment trust, which has specific tax characteristics and investor mandates. UWM is a C Corp, a standard corporate structure. So funds with strict REIT mandates are going to receive UWMC stock, which they are prohibited from holding. They become mandatory forced sellers of that new equity, and the market front runs that flow back, pricing the markdown in right upon the announcement.
That description just confirms my point, though. The pressure is technical. It's driven by professional trading desks and mandatory portfolio shifts, not a fundamental reassessment of UWMC's long-term enterprise value after the deal.
I'm sorry, but I just don't buy that it's purely technical noise. I acknowledge the role of the ARB funds, but the market is also pricing in the cost of that technical change. Namely, the immediate, unavoidable dilution from 108 million new shares and the loss of any perceived scarcity premium. The mechanics reveal a profound and permanent increase in equity supply.
But the increase in supply is exactly what secures the long-term future. We can return to the dilution point, but first, let's just resolve the nature of the drop. You're defining the mechanical selling as fundamental because it creates a supply shock. I define it as technical because the sellers are price indifferent. They're mandated to sell or they're hedging a spread. They aren't making a judgment on the future profitability of the combined entity.
But if that mechanical distortion is allowed to dictate the price, it signals a deeper fragility. We have to recognize that UWMC has historically had high off-exchange volume, over 50% internalization, meaning half the trading doesn't even hit the lit exchanges. This contributes to weak price discovery. So when a stock is susceptible to that kind of fragmentation, mechanical selling pressure, whether it's from ARB funds or forced REIT sellers, has an outsized downward impact on the displayed price. It's a structural fragility being exposed and frankly exploited by the mechanics of this deal.
Specifically, the massive float expansion drives the secondary, high-value narrative, index eligibility. The market is completely missing the long-term structural tailwind here. The issuance of 108 million shares expands the public float by a staggering 93%. This directly resolves the liquidity constraints that have prevented index inclusion in major benchmarks, like the S&P Mid-Cap 400.
That's a compelling argument for institutionalization, I'll give you that. But let's consider the immediate negative impact of that float expansion. While you frame it as good for index eligibility, the increased supply of shares fundamentally changes the dynamic for retail investors who might have been hoping for a short squeeze. That whole narrative, which requires massive liquidity constraints to succeed, is virtually dead now. Short interest of 15.58% against the expanded float suddenly becomes far less meaningful, removing a key speculative pressure point that many investors were banking on.
Short-term speculation should never dictate the evaluation of a long-term strategic merger. The focus has to be on the countercyclical cash flow. Let's move to the heart of the matter here, assessing the natural hedge versus the integration risk and the talent retention challenges.
Right. That is where the rubber meets the road. While the foundational thesis, balancing origination revenue against servicing revenue, which was something like $542 million versus $169 million in Q3 2025, is sound, the risk of actually realizing the projected $150 million in annual synergies is extremely high. Two Harbors is not a simple MSR bucket. They are a sophisticated investment vehicle that uses complex hedging instruments, swaps, swaptions, treasury-based agreements or TBAs to manage their massive interest rate risk.
And I can see why you think that level of complexity poses a threat.
It absolutely does. UWM has to integrate over 500,000 loans, which is a monumental technical task. But crucially, they must retain Two Harbors' proven capital markets expertise, who understand how to manage that complexity. The history in this sector is just replete with botched transfers that lead to regulatory fines, data loss, and massive customer attrition. If they fail to integrate that specialized talent, the combined $400 billion entity could be exposed to serious, unhedged interest rate volatility. The risk profile here is asymmetric. The potential upside is $150 million in synergies. The downside is unhedged exposure to a volatile rate environment.
I'm just not convinced by that line of reasoning, because the synergy target is far more feasible, and the technical integration risk is overstated, given UWMC's existing infrastructure. Let's start with easy money. They have a guaranteed elimination of $10 to $20 million in public company costs immediately. SCE reporting, board fees, listing costs for two simply vanish upon consolidation. That is low-hanging fruit toward the $150 million goal.
Cost savings are welcome, sure, but they don't address the 500,000 loans.
They address the marginal cost. UWM has spent years building a proprietary, highly automated servicing infrastructure. Their marginal cost to service a loan is among the lowest in the industry. This low marginal cost ensures that the rapid absorption of the 500,000-plus loan portfolio can happen without catastrophic failure. The asset they are acquiring is the recurring cash flow, and UWM's expertise is moving volume efficiently. They are buying the revenue stream and plugging it into their established, low-cost platform, maximizing the immediate, recurring cash flow that dramatically improves the sustainability of the dividend. The infrastructure is the defense against the operational risk you're citing.
Okay, but that assumes a smooth transition of a highly complex hedging strategies. If UWMC simply liquidates the existing Two Harbors hedges and replaces them with their own strategies, that involves a ton of execution risk in the derivatives market. If they attempt to incorporate Two Harbors' exotic instruments, they must retain the talent that manages them. The key risk isn't servicing the loans, it's protecting the value of the servicing rights themselves from volatility.
They have a proven track record of managing interest rate risk on their origination pipeline. Scaling that expertise to the combined entity is a challenge, yes, but it is one they are incentivized to solve with urgency, precisely because the downside is so clear. The confidence is reflected in the 100% stock structure. Management is betting their own capital on their execution ability.
That's a fair point on the stock structure reflecting confidence. But let's circle back to dilution and the index inclusion catalyst. You frame the immediate dilution as a necessary trade-off for cash flow and long-term multiple expansion. I just see the short-term pain as absolutely certain, while the long-term benefit remains highly conditional.
The structural benefit of index inclusion should not be discounted. It is a fundamental re-rating event. Doubling the public float resolves the primary liquidity barrier that has prevented UWMC from getting into indices like the S&P Midcap 400. That inclusion will introduce substantial, persistent passive buying pressure over time. This isn't just about trading higher, it's about shifting investor perception. We could see the company move from trading its cyclical mortgage bank multiples, historically, around 6 to 8 times earnings, toward diversified financial compounders, which often command 10 to 12 times earnings. The immediate dilution is the mandatory purchase price for that level of optionality and institutional credibility.
I agree that the potential is immense, but I question the timeline and the certainty, specifically because of lingering governance concerns. We have to acknowledge that the governance structure remains a hurdle for many large institutional index funds. UWM operates under an Up-C structure, where the controlling entity, the UWM Group, maintains absolute voting control. Matt Ishbia's ownership stake translates to a cap of 79% voting control.
While the Up-C structure is present, it's not entirely uncommon in financial services.
But it's a structure that institutional investors, particularly those prioritizing best-in-class corporate governance, remain fundamentally deterred by. Increasing the public flow is necessary, but it doesn't eliminate the substantial governance risk premium that actively managed funds often apply, delaying or even preventing the re-rating you project. So the immediate pain of dilution is certain, while the long-term benefit remains a projection dependent not only on index committees, but also on uncertain macro conditions, specifically the anticipated thaw in the 2026 housing market if rates moderate. If rates remain stubbornly elevated, the origination business remains pressured, and the market may fixate on the dilution and the governance issues rather than the index promise.
That's an interesting point, though I would frame the macro reliance differently. The ability to weather continued high rates is the point of the natural hedge. If rates stay high, the MSR asset value appreciates, the servicing cash flow keeps the dividend safe, and the company survives and potentially grows market share where its competitors fold. This acquisition makes the company more rate agnostic.
Survival is one objective. Achieving a 12x multiple is a much higher bar. The market is currently signaling that they need proof of execution before they'll reward the strategy.
Well, this discussion clearly illustrates the profound tension embedded in the market's initial reaction. We've thoroughly examined the evidence presented in the material concerning this transformative acquisition.
Absolutely. We started by dissecting that immediate 7.4% price decline. I argued the decline is justified because the mechanics, specifically merger arbitrage shorting, and the flow back from forced REIT mandate sellers expose a fundamental supply shock from the issuance of 108 million new shares and the structural weakness inherent in high off-exchange trading volumes.
And I countered that the drop is temporary noise, arguing that the professionals are focused on the strategic resolution of UWMC's cyclicality through the now $400 billion MSR book, creating that critical natural hedge that stabilizes the 7.4% dividend yield. Furthermore,
The necessary dilution is really the key that unlocks index inclusion and the potential for long-term multiple expansion.
Right, and we acknowledge that both index inclusion potential and the structural hedge offer substantial long-term value, but this has to be balanced against the acute short-term execution risk. Success depends entirely on management's ability to smoothly integrate over 500,000 loans and successfully manage the complex hedging strategies and capital markets expertise required to protect those MSR assets, thus realizing the full $150 million synergy target.
So the ultimate trajectory of UWMC rests on whether management can successfully execute the operational integration and realize those promised synergies fast enough to convince institutional investors that the company has transitioned from a volatile, cyclical mortgage originator to a mature, diversified financial compounder.
And the initial price action reflects this inherent tension perfectly. The mandatory short-term pain of dilution and complexity versus the substantial long-term strategic evolution. There is still much more to explore in this material as the deal progresses toward its scheduled closing in the second quarter of 2026.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.